This is the weekend edition of the Daily Gold Podcast, covering precious metals and global capital markets for intelligent investors. Now, here is your host, Jordan Roy Byrne.
Hello again, everyone, and welcome back to the Daily Gold Podcast. Today we're speaking with one of your favorite guests, one of my favorite guests. He's Greg Weldon from Weldon Financial. When it comes to gold focus analysts looking at the macro picture from top down, nobody does it better than Greg Weldon. That's why we have him here. Greg, first things first, as we get started, I want to talk about the dollar. Obviously, we had the move and the news from the BOJ last evening. They're going to go to negative rates. The dollar index has been consolidating for about a year. I'm just wondering if this has any short-term impact on the dollar. Does it change anything in the short term, in the long term? I mean, what are your views here?
Well, that's a lot to talk about, and there certainly is a lot to talk about because there's a lot going on. And I think today's move by the Bank of Japan, really kind of reflects back onto the dilemma that the Fed faces. They're wanting to theoretically push interest rates up. The dollar is an issue. The strength of the dollar, you can look at the dollar index, which has consolidated some of the gains. It did peak previously, came off, made another run at the 100, 150 level in the in the spot dollar index, and it's kind of failed here. And I think there's a variety of things to look at. Let's start with the BOJ no we heard from the BOJ, the ECB, and the Bank of England last week, all of whom said more easing or no tightening in the case of the BOE. And in fact, the 2-year gilt is now below the base rate, which has in the past been a precursor to a rate cut from the Bank of England. Okay, you got the Bank of Canada likely to continue to be stepping on the gas here too. You have countries such as India and Brazil where, inflation kind of coming down because commodity prices are coming down, some of that offset by currency weakness in those places, but they have had such big moves in their interest rates in the bond markets where they actually have room if they wanted to ease, in the sense that it's a currency issue where they want to keep the currency depreciating in the case of India against the renminbi, which has now joined the party. So, wow, you got a lot going on. And if the Fed is perceived as kind of maintaining their forecast as reflected by their dot plot, okay, that is, what is supporting the dollar here. That is where thoughts of additional bullishness in the dollar come. If you look at the broader Fed trade-weighted dollar index, it's actually at new highs in another bull leg here since the Fed raised interest rates, whereas the dollar index is actually, until today, was lower from where the Fed raised interest rates, because the thought process was by raising rates, they unleashed some of this deflationary pressure through the dollar, through commodities, through emerging markets, and that would actually take some of the steam out of the dollar. The Fed faces a real conundrum with the dollar, and I think it puts pressure on them to continue to back off on their dot plot forecast. And we know the markets have been at odds with the Fed for some time. And, the Fed, 18 months ago, the Fed would have hiked rates a couple of times by now. And the market has basically refuted that thought process. And so far, the markets are right. So it really puts the pressure on the Fed, frankly, to be less hawkish, because if they're not, it threatens to unrail some of the benefits you might get from easing overseas. Now, without making this answer too long, you can actually skew things entirely the other way if you want to. I heard this argument this morning. It's kind of interesting. I'll throw it out there. I don't think it dominates by any stretch of imagination, but just to play both sides of the coin, easing in all the places we just mentioned, if it kind of revives the economies and the U.S. is, ahead of some of these other economies, that might even, give some thought process to the Fed that they're on the right track by maintaining a little more hawkish forward forecast. I don't buy that, because I think countries are reacting to the fact that deflation remains dominant. And the Fed, for all their talk about pushing inflation up, have failed to push inflation up. And you can throw it at oil all you want, but you're seeing inflation expectations now making new lows. And that's got to be screaming at the Fed that they need to really walk gingerly here.
Greg, sticking with the currency issue, why don't you talk about China and how does that factor into this? I mean, could the next market shock possibly come from China and its currency? I mean, what effect could that possibly have later this year?
Well, I think you've got a couple things going on with China, which in my mind, when I listen to the pop media, is a little bit misconstrued. To me, the move on the currency, something we forecast in our 2015, last year, a year ago, January, our currency war part 2, because 2014 was our currency war part 1. 2016, we just published our currency war part 3. But last year, we predicted that the renminbi would join the party. That was one of our key themes, that China would have to move to a currency means as a monetary tool because of exports, because of what they were facing in terms of a mathematical slowdown in the economy. The problem is, just prior to that, you had a big run-up in their stock market. They facilitated some wealth reflation. So you had an elevated market at a time when they moved on their currency, and that facilitated just a dump because everyone's afraid they're going to keep moving on their currency. We want to get our money out of China. So you saw some capital outflow. You've seen what happened in reserves. I think that from the perspective of some weakness in their currency is actually a good thing for them. I think that's been lost in the mix here. If you look at the economic statistics, they are nowhere near what the stock market might suggest if you were to try and make that correlation. And frankly, there isn't that correlation, which is part of the problem with the psychology around China's imploding. The math gives China a look of slowdown, which is true in the sense that from a percentage basis, their growth is slowing. But it's against nominal levels that have become so large that the actual nominal increases in GDP are increasingly greater. So let's keep perspective on this. People talk as if China is contracting. They're not. They're not at all. The numbers are posting newer highs, nominal terms. So I think there's a bit of a disconnect between where the markets are, and especially the stock market, and where the economy is. And that leads me back to the renminbi, because I think there is more to come on the downside in the renminbi. And it's difficult here to talk about the treacherous, environment that we face right now, because it does run the risk of unleashing a psychological event that is not really justified in my view. Yes, China has problems. There's giant holes in China. But to me, there are less holes in China than a lot of other places, Europe being one specifically. Now, the second part of what I may give as an answer to that is it really actually maybe kind of a little more subtle, but maybe more important. And that is the case of India specifically, reacting to China's move on the renminbi. It's kind of viewed that China is starting this kind of little currency dynamic, when in fact, China is the very last participant outside of the U.S. coming to the party. Okay, China's currency depreciation here is only catching up to what we've already seen in Thailand, in Indonesia, in Malaysia, in India, in all their competitors, to the degree that now, though, because of the way it's played out, China's kind of seen as opening the door for all those countries to potentially go again on their currencies. That leads back to India, where India says, hey, we can cut rates if we have to here, if we want to maintain our currency depreciation. This currency war, Jordan, has intensified over the last 2 months. You go back to December when you had like Angola and Azerbaijan. I mean, Azerbaijan, resource country, linked to Russia, has trade with China, depegs their currency, and the dollar rises 48% in a single day. I mean, this is acute, this dynamic right now. And I just don't see in a bigger picture theme how it doesn't lead to further economic kind of macro deflation, which they'll continue to try and fight with currency. So to me, currency war is, has escalated and is full bore right now. And China's at the center of it, but for reasons that I think are a little different than the way the market is perceiving them.
And Greg, it's great that you mentioned currency war, because I want to turn to the currency of all currencies, gold. And I know you actively follow, how gold's performing against other assets, other currencies. And, I'm sure you've noticed that gold has really started to strengthen against equity markets. the big equity markets around the world. I mean, I personally think that relationship has bottomed in favor of gold. Gold against foreign currencies is performing fairly well in recent weeks. Also, gold in nominal dollar terms is performing well in recent weeks. I don't know. I mean, personally, I don't think gold has bottomed yet. It's just to me, it just looks like it's acting the same as it's always acting. Although it is gaining more strength in real terms, I should say. I mean, what's your view on precious metals right now?
It's kind of threefold. I mean, the first part of the view would be, of course, linked to the dollar. And I think that one of the things that we've put out there as a wild card, potentially for 2016, is some kind of officialdom move on the dollar, some kind of statement. For example, the December FOMC minutes from the meeting at which they raised interest rates, there were 7 specific mentions of dollar appreciation. We haven't seen 7 mentions in the Fed minutes of the dollar in I can't remember how long. Okay, maybe you get one, occasionally a second one, but never 7 that I can remember. I'm sure if you go back far enough, you'll find some. But that just leads me to believe that there is enough awareness now among central banks, at the Fed, that dollar strength beyond the levels that we've seen as the highs in the last 2 years could be the thing that triggers another crisis, because you're on the precipice already with what's already happened in emerging market currencies, a la the new highs this week, 12-year highs in the trade-weighted dollar index. So, from that perspective, I think that the dollar provides a wild card potentially on the downside in some kind of manipulated way from the Fed, whether it's through dot plot or whether it's actually comments on the dollar or what have you, or easing by other central banks that keeps the Fed in the game theoretically, or just from the macro perspective in the U.S., you're starting to see some wobble in the labor market kind of out of nowhere here. I think that's a bullish potential surprise for gold. I don't know that gold needs a bullish potential surprise right here to have suggested it's seeing a bottom. You have technical levels that are key going back to 1999, going back to 1976. You've held some of these real key long-term Fibonacci levels. You've got patterns here, to me, based on momentum that have never seen this level of divergence. Love the gold market against the S&P on that chart. You're breaking out really like now, not today, with the action in stocks relative to the BOJ's move, but bigger picture stuff. I mean, gold has not been this cheap relative to the stock market, outside of right now. You have to go back. There's a period between 1998 and 2001, and that's it. The declines that you've seen in gold, only 3 other times has it been this depth relative to the stock market. Each of those 3 times was a major buying opportunity. So, there's a lot going for gold right now, let alone that these countries are competing to devalue their currencies to the degree of going to negative interest rates. You talk about gold as a non-interest bearing dynamic. Well, maybe there's a lure there when you have negative interest rates everywhere else. You want to hold your currency, you want to hold your wealth in a paper currency that has negative interest rates on a deposit level, and continues to blow out debt. We haven't even begun to talk about the fact that all of this is happening, and all this money's been printed allegedly to paper over a problem that has only gotten exponentially larger since 2008. U.S. debt outstanding has more than doubled. It's almost $19 trillion now. I mean, $19 trillion. When have you heard that on TV lately? You don't. All right. Almost every European country, the latest BIS study showed the increase in debt to GDP ratios from corporate, government, and households. And the numbers are mind-boggling. I mean, they really are. So, from that perspective, too, you have currency wars, negative deposit rates, and the highest levels of debt ever. Now, either it's a deflationary collapse and gold goes down less than everything else, or guess what? Gold's going to be a store of value again, and a safe haven play, particularly if and when, it's not if for me, it's when and how we get back to the dollar, making a move based on what the Fed will be trying to do, which will be move the dollar lower.
Greg, let's talk about the stock market. I mean, it's a week or two ago, it got very oversold. I mean, it's probably having an oversold bounce. I mean, maybe it lasts for a couple months or at least a couple more weeks. How do you think the stock market and its potential for breaking to new lows later in the year, how might that impact all these things the dollar and gold?
I think there's a dollar negative, gold positive element to that. That's the underlying thread here. And my first comment would be that this market looks different to me than what we've seen in the past. Looks more like a 2008 than a 2011 type of episode, just to keep it more current, because I can go back into the early 80s with my experience in the market, 31 years. This seems from many angles to be something more serious. You haven't had capitulation. You haven't had liquidation. You haven't had the degree of pessimism in the consumer surveys on stocks. We just got the conference board numbers yesterday. You're nowhere close to levels of pessimism, again, for specifically to the question about will stocks go up or down the next 12 months that you have seen even at lows such as 2001. Technically, you've done more damage than we've seen in a long time at one of the most stretched technically dynamics. Patterns. From that perspective, one of the most stretched markets I've seen in my 31 years of doing this. So I think the lows are very much at risk. You could even see something of a pattern that looks kind of similar to 2007, 2008, where the market is kind of right here, does rally, it gets another less robust little up leg here, and then comes the bigger picture breakdown. I could see that same scenario playing out just because we've seen it once technically, but more so because the backdrop sets up for this, particularly given where the Fed's dot plot is. I mean, the Fed's going to be put to the test here for sure. And you have, landmines that are being activated now in terms of countries that are, attacking their currencies or cutting interest rates, to levels that seem almost, unbelievable, against which you still have record debt. I can't emphasize that enough. The complacency around that one factor is virtually mind-boggling. It's eye-opening to see how many people have their eyes closed to that specific dynamic. So I think stock markets are at risk. I think stock markets have been artificially inflated. Each round of QE gets less bang for its buck. We wrote about this in the book I wrote in 2006 and 7. We called it the DSR. And we said at the time, before the Fed ever contemplated buying bonds, the Fed would buy trillions of dollars of bonds, inflate their balance sheet, and each successive one would have a diminished impact in terms of asset prices, which would be the only thing they would really have any significant impact on in the first place. We call that DSR, the degradation of stimulus return. And you are there. I mean, you can only go so parabolic with your balance sheets. The slope of the BOJ's projected balance sheet expansion is nearly straight up and down. The ECB is pretty close, and if they go again, it'll be very, almost as straight up and down as you can get without it being straight up and down. The Fed has gone sideways. The U.S. stock market has been linked to the Fed's balance sheet really since 2009. So the bigger picture concern is you still have massive debt that hasn't been pared down, that nobody cares about anymore because you've gotten the appearance of reflation because you've driven asset prices up. Consumer borrowing at unprecedented levels has driven retail sales. You throw in the bonus of lower gasoline prices, and this is why we are where we are. From here, how are you going to recreate all of that to get another 15, 20, 25, 35, 40% upside in stocks over the next year or two? I don't see it. I don't see it anywhere.
Greg, last thing I want you to talk about is oil. I mean, how much of a wild card could that be to everything you've talked about? I mean, in the case that oil has a extended oversold bounce.
It has been a wild card. It really has. I mean, if you go back to October of last year and at previous occasions, actually a year ago, October, the market looked like it was going to come unglued and then held because you had the big dump in energy and gasoline prices. And you've seen that specifically flow to eating and drinking establishments and the retail sales numbers. The numbers are very clear on this. People say it hasn't had much of an impact. I beg to differ. It's had a big impact, and it's kept things from falling apart much earlier than they seem to be starting to now. How oil plays out, gosh, Jordan, I mean, that's the $64 million question that I really can't answer right now. I mean, I think this decline is close to over. I think that the dollar plays a major wild card role there that could be bullish. But when I say bullish, I'm not saying bullish. I'm saying less bearish. If you look at the swaps in Brent, they're diverging. If you have record highs in inventory. We know that. You also just coming off a week of record short positions held by speculators. So I think, yes, some kind of rally here, and then maybe just sideways. Start to establish some range at these lower levels. Doesn't mean we have to go to 15, and doesn't mean we got to go to 60. It means we can rally from here back up to the $45 to $50 level, and then establish a $15 or $20 trading range that could exist, through the end of the year. In that case, okay, it provides a problem for central banks because you're not getting less money spent on energy as a stimulus for the consumer. But at the same time, at some point going forward, if you flatten oil prices, okay, just stabilize them, the math will start to work against deflation in the CPI numbers. So can you imagine a scenario where the consumer's kind of hamstrung, the stock market hasn't rallied, you have no wealth reflation there, and oil prices flatten out to the point where, the core inflation rate starts to move towards the headline inflation rate? I mean, wouldn't that be interesting? Because then what's the Fed going to do? Are they going to hike rates, send the dollar higher, bring everything down again? I mean, it's almost like, lower energy prices have really, so helped the Fed to the degree that it's kept inflation down where they haven't had to raise rates because I don't think they really wanted to. I think this was all about credibility, more so than we feel the economy, is really robust enough to withstand 4 interest rate hikes this year and 4 next year. I don't think there's many people out there that ever for one second believe that that's going to be the way things play out. But in terms of oil, yeah, rally near to medium term, then establish some kind of range and probably, range trade, for the medium term.
All right, Greg, we got to leave it there. But before I let you go, why don't you tell our listeners how they can follow your work and the services you provide?
Sure. Weldon Live is our research product. It is basically a video, it's charts, and it's me talking. You don't have to look at me. You just see the charts. We offer the PDF, printable version of all those charts, and we offer Trade Lab for each of our sectors, and that is specific trading recommendations. There are 7 Weldon Live channels. Subscribe individually or in package deals. It's global macro, fixed income, foreign exchange, metals, stock indexes / ETFs, energy, agricultural commodities. So that's the research side. And I got to tell you, we're really excited about the potential opportunity right now for our gold program. We have a leveraged long-only gold program that performs extremely well during bullish periods of gold. And we have not, really went out and marketed this fund. It's managed accounts. It's transparent. It's individually owned. We don't touch the money. It's not pooled. You get daily reporting. It's fully transparent. We think the opportunities right now for our gold program, which has a low minimum investment, are phenomenal. And we don't go out and market our programs unless we really believe the timing is right. We think the timing is right now for both the gold program and our commodities program. Same time. Our wild card is, some kind of move on the dollar from officialdom. And that could, along with El Nino, which is another wild card we didn't even talk about for commodities, spur some interest in the commodity markets. They may have seen their lows as well in here too. So we'd welcome any of your listeners to come to our website, which is weldononline.com. They can sign up for a 30-day free trial to the research and get information on the managed accounts programs.
Greg, if one of our listeners wants to personally get a hold of you, is it okay if you give out your email address? How can they do that?
Yeah, absolutely. You can email me at Greg Weldon. That's GregWeldon at weldononline.com.
All right, Greg. Well, thanks so much for coming on. I really appreciate it on short notice today, and look forward to having you back again the next couple months.
Yeah, it's my pleasure, Jordan. Always enjoy speaking with you.